please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning and welcome to Power Breakfast in the Mumbai News Centre. I'm Surabhi Upadhyay and with me is Mangalam Malu. Mangalam, what I'm thinking is it's green on the screens pretty much all throughout. Is this the 11,000 day? Records are just coming and going on the street.
Records are just coming and going on the street. So it'll be Mount 11,000. That is the big question. But you talk about bull markets climbing walls of worry. Yesterday, bull markets climbed the Wall Street of worry as well. Shutdown or no shutdown, that's not happening. Bulls went into trade buying, believing that the shutdown will take care of itself, and so it did. So there is a bit of a consensus as far as the shutting down is concerned, but we have a lot of cues to work with. The biggest cue is Mount 11K, whether it will come or not. But first up,
so global cues are pretty all right, as we've been telling you. Let's rewind back to what we saw happen yesterday at home, and it was fireworks in the Lal Street once again. The market closed at a fresh record high. The Nifty is now just 50 points away from that 11,000 mark, and the Sensex was not to be left behind. That index was up to 150 points, and now that index is just 200 points away from the 36,000 mark. Midcaps came to the party late, but they came in style. That index finally actually ended up with a gain of 1%. The Bank Nifty saw a mild underperformance compared to the other indices that we are talking about. But the question is, Mangalam, as we've been saying, is it the 11,000 day or not? I was looking at the graphics and the data that you put out. I mean, the kind of FII buying that we're just getting, it's just, pushing this party higher and higher.
That's true, Surabhi, but also remember, as a counter to that, we're getting FIIs selling in index futures too. Right. So perhaps they've hedged it, but I take your point. The FIIs, they are pumping in money, and why not? Our markets are doing well. The only case is that why aren't they pumping money everywhere else as well? Are they pumping it everywhere else? We have to keep an eye out on that. But just watch out for the global markets. Yesterday, Wall Street at a record high. We are talking about how it's climbed the Wall Street of worries, so to say. Senate has reached the deal to end that shutdown. As a result of that, we saw the Asian markets, they're up almost 0.75%. The SGX Nifty indicates that Mount 11,000 could just be today. And yesterday, our markets, we ended at record high. It picked up steam in the second half. If you take a look at the Nifty itself, was under a mild bit of flat sort of trade in the first half of trade. And then we had two big boys come by, Reliance and TCS. They've contributed to the gains. And they're not just any boys. If you take a look at the market cap of both Reliance and TCS, Reliance crossed 6.15 lakh crore yesterday, and TCS, it looks like a nice little battle going between the big boys to get the highest market share or market cap in our markets as well. So the Nifty gained 72 points. 50% of that was courtesy Reliance, add TCS, and later in the day we had Axis Bank results as well. Add both of them to that, and you see that Reliance, TCS and Axis Bank nearly did all the heavy lifting. About 66 points of the 72, 90% gains contributed by the three big boys. Mid-caps, you spoke about them coming late to the party. Jubilant Food and Just Dial. Well, look at the moves. Jubilant Food up 20% of the last two trading sessions. Post the numbers. Just Dial just ahead of numbers, up about 9%. Flows flowing in thick and fast. But remember, FIIs have sold about 1,800 crores in index futures. They've sold about 3,500 crores in index options. Watch out for a couple of impediments. At 11,000, the put-call ratio is elevated. And yesterday, despite the market going higher, we saw the wicks which spiked, and the maximum open interest is still 11,000. So will that be a bit of a hurdle? If it is crossed, then it's case for a lot of short covering, so we can see further up moves.
I'm trying to see a speed bump down the road, at least for today. I can't kind of pinpoint anything. But let's also talk stocks, earnings season. So I guess some important earnings after market hours yesterday in focus?
Yes, we'll start with Asian Paints. In fact, apart from the earnings that came yesterday post markets, we also have Indiabulls Housing Finance today, and United Spirits. That stock's been buzzing around as well. But we'll talk about the ones that came by. Asian Paints, the third quarter takeaways was one, revenue missed estimates. The big boy missing revenue estimates and single-digit volume growth despite a favorable base is something that I don't know how well the street will take. The margins did improve given the cost rationalization. Let's see what the company has in terms of triggers going forward. Just Dial, year on year, the revenues grew 11%. That's a positive. But the margins came off as the company ramped up other expenses. Quarter on quarter, we saw some improvement in the margins. Rallis, again, revenues up 19%. Margins came off a bit. Saskin Tech from the broader markets doing really well. Midcap IT, again, the theme. 20% revenue growth, and EBIT up 140%. So watch out for that. Then from the metal space, we had tin plate, the Tata Group company, up around 146% on the top line, 184% on the bottom line. And we're talking OMC. So Indian Oil Corp said we will consider issue of bonuses on Jan 30th. So that is one stock we'll watch out for. And Kalpataru Power Transmission, they've bagged new orders worth 871 crores. So that stock should be up and about. 2018 will be a year of restructuring and growth. That's the message coming in from Tata Sons chairman N. Chandrasekaran. He spoke to Shireen Bhan at Davos, where the World Economic Forum is currently taking place. Take a listen to what he had to say.
Chandra, appreciate you joining us here on CNBC TV18. Last year when you were here, the announcement of your taking over had been made. You hadn't officially taken over. It's been quite a year since then. Before I talk to you about Davos, let me ask you about the year that's been at Tata Sons.
Yeah, it's been a good year, a year full of satisfaction. I think we have embarked upon a number of initiatives. We've looked at building the right team. And as I mentioned to you in your interview,
yes,
we had identified the important issues to put behind, and we have addressed some of them, rather the most critical,
which is the telecom
ones of them,
piece.
telecom, then we have addressed the steel, and all these transactions will conclude in 2018. Then we are systematically going about restructuring some of the other businesses, and also we just announced our expansion of our steel business. We cleared about 23,000 crores of investment for expansion in Kalinganagar over the next 3-4 years. We're looking at stressed assets, and we're doubling down on Tata Motors. And we are work in progress with respect to the themes of simplification, synergy and scale.
Yes, several things that you've talked about there. So in a sense, if 2017 was a year of review, assessment, 2018 is likely to be the year of restructuring, so to speak?
I think it will be a combination of restructuring as well as focusing on growth. Clearly, we have 6 or 7 verticals we've identified, apart from steel, motors and TCS. Definitely consumer and retail, financial services and infrastructure.
The market seems to be excited about the consumer-facing businesses in hope and anticipation that there is going to be some significant changes there. Is that accurate?
I think, we are looking at it very deeply because there is a significant opportunity for the group, considering the brand and the consumers that we already have, a very large customer base. There's a lot of synergy. So we're looking at that, and we are also trying to see how we can leverage digital in that segment and other segments. So I think lots to do.
So what would be the priority when it comes to the consumer-facing businesses? For instance, whether it's Tata Global or it's your retail business, etc. What is the overarching vision that is going to define the way that you go about these businesses?
I think each one of these areas will definitely have the same themes play out. Simplification will be a theme that will play out. Consolidation will be a theme that will play out wherever it's possible.
Is it possible in the IT businesses? Because that is a question that I last asked you, and that seems to be again something that the market is anticipating, whether it's Tata Elxsi and so on and so forth. There's a lot of activity around those stocks.
See, in the IT business, TCS is a very, very large player. And other players we have are small and they are focused on niches, and that's not an area I'm ready to comment upon. But in many of the other businesses like consumer, retail, etc., we need to see, because some are listed companies, some are unlisted companies. So how do we bring the power of the group together is something that we are looking at, multiple options at this point.
Do you start addressing the cross-holding issue as well in 2018?
Yeah, see, I think simplification means many things. Removing the cross-holding is one of them, which we have done quite a bit, and whatever left we will complete. Consolidating is another option, where sometimes we may feel that couple of companies can come together.
Which is the vertical that you see ripe for consolidation, most ripe for consolidation today?
Whether it is ripe or not, the verticals I think consumer retail and infrastructure, these are areas in which there's a lot of opportunity, and we need to pay attention, which we are looking at.
How satisfied are you with where things are at Tata Motors? Because that again was a focus area that you spoke of in October when we last met.
I think what we have done this year, I'm extremely happy. I think the focus that we have brought in terms of commercial vehicles, where we really are going for market share gain, as well as operational improvement, is working very well. And passenger cars also is doing well. I think Tata Motors domestic market has been an area where there's a lot of action, and I've been pretty happy with where we are, but long way to go.
And it's all about the earnings that are coming in now. Asian Paints reported Q3 numbers yesterday. Who better than Mangalam to tell us how it's like? I was a little confused. I don't know what's happening here, Mangalam, because the revenue number was well below the poll that you had put out. And at the same time, they've managed to grow margins quite handsomely. So how do you cut it? What's the, the sum and substance?
I think it's a weak set of numbers, whichever way you cut it. I'll tell you why. Because the company is focusing on margins, and that is despite the rising crude environment. What are they focusing on margins by doing? One, they've rationalized some of their ad expenses, they've rationalized some of their other expenses, and they've cut their employee expense as a % of sales. So I don't know whether that's operational efficiency that is driving margin growth.
That's just belt tightening.
Exactly, that's just belt tightening. But just take a look at the top line, 10.5% top line growth, and it was 6% realization growth. The company had taken 5.7, 5.8% price hikes. So that means the volume growth was just 5 to 6%. And in a quarter where people were expecting 11 to 12% revenue growth coming by, or a volume growth coming by on a favorable base, 5 to 6% doesn't quite cut it. So the revenue, that one missed estimates. And Asian Paints, remember, is no mean feat. It is the biggest boy in the industry. Had it been not just Asian Paints in the whole industry, one would have said no problems. But Kansai did very well. They did double-digit volume growth. We have Berger and all the others as well. And we'll keep an eye out on that. But just keep an eye out on the fact that the operational performance saved the day. Going forward, what do they do with it? Because crude prices are increasing. They're up 23% year-on-year, 19% quarter-on-quarter. The home improvement business did well, but then it's on a very low base, still in investment phase and still making EBIT losses. So we'll have to watch out for that. Going forward for Asian Paints, there are a couple of triggers. The first one, new capacity coming on stream only in the second half of FY19. So until then, any sort of growth coming in would be a bit of an issue. And in the home business, if they do go ahead and make some acquisition in the near term, it will be margin dilutive or return on capital dilutive as well. So we'll watch out for that. But what the management said was the economy is growing, demand for paints is not growing as much. They were hurt by South, and they haven't taken any price hikes yet. So let's see, let's hear out what the management had to say in the earnings call.
There was some tightening of the belt that we had undertaken on some of the expenses. Plus, there have been some investments on renewable energy, which has also helped our power and fuel costs. So all these things add up to that 6% sort of negative number versus last year. There have been some costs which we have tried to control this year. Like I mentioned, power and fuel. Apart from that, even I think the marketing spend this quarter have been low versus compared to last year.
Demand in the south was not very good, partially because of an extended monsoon that lasted later. We have seen it revive in the month of December, so it's very tough to put these things really down.
Okay, so that's Asian Paints, not the best of quarters for the company. Now let's move to some news coming in from New Delhi. The countdown to February 1st has well and truly begun in less than 10 days. Finance Minister Arun Jaitley will table the union budget for financial year 2019. And from what we're picking up from our sources, the government is gearing up for a paradigm shift as far as the divestment policy is concerned. We learned that the government might set a higher divestment target for itself for the next financial year, FY19. Sapna Das is joining in with the details. Sapna, what are you picking up?
Well, clearly, the HPCL-ONGC deal has been a huge success for the government and a big boost for its disinvestment program. That clearly sets a precedent for what we may expect in FY19. Also in terms of what the budget announcements may be in terms of the target the government may have actually already been allocated since the budget documents are already now under printing. Having said that, clearly the intention of the government is now to create value for CPSEs. Unlocking value for them, also creating value thereby for government equity in these CPSEs. So the expectation now is that probably the consolidation and acquisition policy the government has implemented in FY18, this may get a further boost in FY19. Also, very clearly, those CPSEs who do have surplus cash, here the investment guidelines had been put out by DPAM quite some time ago. All those CPSEs, either they expand and they use it for the business purposes, or they also come back in the shape of buyback. So the second aspect of the disinvestment policy will be on that front. The third aspect, and that is linked to the first one, basically, the budget targets may be evenly balanced between strategic stake sales and minority stake sales. They could be a bit more focused in terms of the strategic stake sale, and that is something that we have to watch out for. Fresh offerings also may be a part of that, though of course a couple of them are still pending in the current financial year. So you have to wait and watch and see how that really goes. Last but not the least, when they have already exceeded FY18 target in January by over 20,000 crores, they are sitting above 91,000 odd crores, so to speak. There is no reason to basically question the fact whether it could be a 1 lakh crore disinvestment target for FY19B or not. And even if it is not, the fact remains that this year has set the ground rule, has set the precedent. They may have a lower B and try and overachieve it by the end of FY19.